Hi, class, and welcome to Chapter 10. Within Chapter 10, we'll get into hybrid securities. Hybrid securities include preferred stock and convertible securities. As we think about convertible securities and preferred stock and common stock, how does preferred stock actually differ from common stock and from debt? Preferred dividends are specified by contract, but they may be omitted without placing the firm in default. Good example of that is most preferred stocks prohibit the firm, company, from paying common dividends when the preferred is in arrears. In other words, they owe you money and you own preferred stock. So you're telling them contractually that you don't want them to pay out the common stock holders because you want your money first. And that's exactly why it's considered preferred stock. Usually there is a cumulative up to a limit though. For example, if you are in arrears and the company owes you, let's say dividends, because you're a preferred stockholder, they may decide to negotiate, or they may decide to maybe allow you to get on the board. So there's all kind of ways that you can somehow still benefit from being a preferred stockholder, and it may not always be monetary. It may not be in the form of dividends. Something to think about. Preferred stock. Some preferred stock is perpetual, but most new issues have sinking funds or call provisions which limit maturities. Preferred stock has no voting rights. We know that from previous conversations, but may require companies to place preferred stockholders on the board, sometimes a majority, if the dividend is passed, which means they haven't actually been able to stand up for their end of the contract and give you the prescribed dividends or what have you, some yield on your investment. So they're saying we'll do some other things, like for example, let's put you on the board. You get to actually vote in maybe the new CEO, or you may vote on the direction the company's heading in. So that's important to understand that you may not always get the dividends, but there are some things the company will actually negotiate with you when they realize they need the dividends to keep reinvesting back into the company. So is preferred stock closer to debt or common stock? What is the risk to investors, to the issuers? All those kind of questions you need to understand before you decide either on common stock, preferred stock. A great deal of companies prefer to give common stock, and it's to their advantage. Let's just say that. Advantages and disadvantages in preferred stock financing. So advantages is dividends, obligations not contractual. Avoids dilution I should say, when you dilute, of common stock. Avoid large repayments of principal. Wow. Now some of the disadvantages is preferred dividends are not tax deductible. So typically costs more than the debt. That's a disadvantage. Increases financial leverage and hence the firm's costs of common equity, common stock. Convertible bonds, you can see example of real convertible bonds issued by the internet companies. You can see below there, I'm not going to read every single company there, but you can see how the size which was issued, the convert price, and what the actual price of issuance turns into. So what is the convertible's straight debt value? And number two, the implied value of the convertible feature, convertibility, we should say, feature. You can see those numbers there kind of speak for themselves. Implied convertibility value. Because the convertibles will sell for 1,000, the implied value of the convertibility feature is 1,000 minus the $887.96 equals $112.04. Wow. At maturity, that's when it's converted. The convertibility value corresponds to the warrant value in the previous example. So how do convertibles help minimize agency costs? Agency costs due to conflict between shareholders and bondholders. Asset substitution, or we call it the bait and switch. Firms issue low-cost straight debt, then invest in risky projects. Bondholders suspect this, so they charge high interest rates. So tit for tat, so to speak. And convertible debt allows bondholders to share in upside potential. So it has low rate. That's everything I could think to share with you. The rest of the PowerPoints on the module is something I would like you to explore, but this was a quick snapshot of what hybrids are all about. Thank you, folks. We'll see you in Chapter 11. Not bankruptcy, but Chapter 11 of this particular textbook. You get it? Okay.